And beyond this, what we're saying is a double dip recession is most likely what we're going to see over the next few years, because there's going to have to be serious damage done to the labor market to get inflation down this cycle.
Wow.
And I just don't think the Fed
double dip like 80, 81,
exactly.
down? I've never heard that. That's original.
That's like the post-crisis conversation, Tom.
Yeah.
10 years ago. Before we get to the second recession, can we
Yeah,
talk?
you know what? It seems like every single time there's a recession, people start talking about, oh, it's going to be a double dip. It's going to be a double dip. It's literally when I got in the industry in real estate, starting in like the late 09, early 2010, when I started getting in, I'm like, all right, so what do we got here in terms of real estate? Oh, terrible market. Oh dear, worst crash in a very long time. Okay, interesting. And as soon as we started recovering, and the real estate market bottomed out at 2011, which is crazy because it started falling in 05, didn't bottom out until 11, which is about 6 years later. You had everyone worried about this shadow inventory of homes that banks were hoarding, that they were going to release onto the market and crash the market again as soon as prices popped up a little bit. It was just a bear market rally, and the real estate market was going to double dip crash. Let's listen in more for a moment here just to see what this guy's talking about, and we'll do a little bit more analysis on this double dip talk.
Higher income cohorts, they're dipping into savings at an astounding rate as well. That's probably more sustainable because they've got a huge cushion. But you put it all together, we're seeing shallow recession because eventually the consumer wobbles over. And once the consumer wobbles, then businesses stop hoarding that labor like we saw in 2000 with inventories. And then you get that cascade effect. But it should be fairly shallow because we do think by the time this happens, we're talking later this year. And now the Fed's starting to pivot towards cuts for 2024.
Well, that's what I was going to say. What's the Fed's response to a shallow recession? Is it rate cuts if inflation hasn't really been killed off?
I think they're gonna hem and haw on this as long as they possibly can, but eventually they will pivot towards rate cuts, but not this year. Now that's interesting because the bond market, as of Friday morning before the jobs number, was pricing in cuts as soon as we'll say October or November of this year. So the market this morning is pushing those cuts further out, it looks like, but the Fed is still going to have to wobble itself towards cuts or pivot towards cuts at some point next year, I believe.
Is just a shallow recession and nothing deeper enough to justify credit valuations where they are, given the ongoing rally that people have really played into?
Yeah, I would say no, both in the investment grade and high yield space, no. I mean, we got IG spreads, investment grade corporate spreads, somewhere around a 115 to 120. Even in a shallow recession, historically, you're talking about 180 to 200. That's a very shallow recession. And by the way, you can make the same extrapolation to the equity markets, where you're looking at how much do earnings contract in a shallow recession. It's 15%, 20% perhaps. So nothing seems to line up even with that shallow dip in earnings and output that we're expecting. So there has to be some risk asset pain.
Chairman Powell Volume 2. Tomorrow, can we finish there? Do you expect anything different from the Fed chair?
No, I think what he's trying to tell us is we don't know where we're going to terminate the funds rate. It could be 5, 5.25, 5.5, but we're confident we're going to hold it there for a while. And we don't know what a while is, but it's probably for the remainder of this year. Beyond that, he's data dependent. I hate that phrase. We all hate that phrase.
Tom loves it.
But we need to see numbers. We need to see the jobs numbers, and we need to see how quickly inflation's coming down. And all of it comes down to one important data point or concept that you're not hearing people talk a lot about today: labor force productivity. If labor force productivity somehow rises and participation rate rises, then it's a game changer. I don't see that happening, though.
Participation did on Friday. Is there anything about the data at the moment that makes you think, I don't really know what's happening here? I can't draw conclusions about the post-pandemic realities of this labor market.
Well, that's a head scratcher, and what we can broadly say is it seems that 18 to 25-year-olds are still, to some extent, boycotting this market, this labor market. We don't know why they're doing that. We can suspect, we can give anecdotal reasons. But
Tom's going to give you one right now.
We all have, and we can have our cynical reasons why, but for whatever reason, they are boycotting this market. And when they do join the market, the labor market, they're not putting their best efforts forward. So labor force productivity is negative.
One of the great things of Strategas is the inbred optimism of the shop when Jason Trent had started it. Don't tell me, Jason Trent, it's 100% in cash. What's the equity belief at your shop?
No, so we're looking at, again, consistent with a shallow recession, a modest earnings contraction, and that means that, say, the S&P, let's put a ballpark here, let's do $200 per share for earnings for this year, and a 17 to 17.5 multiple. That gets you, we'll say, $3,500, and if the Fed, pauses and pivots sooner than expected, maybe you get back down to 3,600. But we're still bearish at these levels on equities. We just don't see.
I
the
just love to hear
fundamentals.
bond guys talk equity.
I
It's
just
great.
enjoyed that assessment.
I love to hear bond guys talk equity. So let's consider that for a moment. So the individual's not wrong in that the bond market is pricing in rate cuts probably as soon as even September. And we're pricing in over 1% of rate cuts in 2023. Now, Jerome Powell has been telling us, hey, we don't have any plans for cuts in 2023. But let's be clear, in his last FOMC press conference, he was pretty dang blunt, suggesting that, look, we're going to look at the data. And if inflation comes in hot, then maybe we have to go higher. And if inflation comes in lower, and he purposely implied this because he didn't want to say the word cuts, then obviously they would cut rates and respond accordingly. Now, I think there's going to obviously be volatility over the next not only year, but certainly the next weeks and months here. As we try to get as much data as we can, I think this sort of Nike swoosh that we're going through is going to be pretty spiky up and down. But this idea of a double dip recession is really interesting. Really, it's a Michael Burrian argument. It's this idea that, hey, you know what? We could end up seeing a soft recession here in 2023. Then all of a sudden, the Fed cuts. But oh no, those cuts lead inflation to actually pop up again. Now people can't go and rely on their savings because their savings are gone. Now people can't rely on the ability to go borrow and get another personal loan from SoFi or max out their credit cards because they've already done that. And now if you get into a situation where inflation starts popping off again while the Fed's cutting, now the Fed has to raise rates again at the same time as people don't actually have a way to spend through the recession anymore. So now what happens? People stop spending. And then that's where employers actually start saying, okay, this isn't a hunker down style recession. This is now a real recession where we actually have to make meaningful cuts to our businesses. Now we lay people off, which kills spending even more, and you get a deeper, ugly, dark, double recession. It's possible. What the individual is saying and the warning from Michael Burry is absolutely possible, especially when you combine with that the US-China geopolitical tensions, the fear that, yes, combat with China could actually be something that occurs in the future. Obviously, we shot down their darn spy drone, spy balloon over the weekend. But look, it's probably going to be months before we're actually able to conduct sort of a, dare you say, an autopsy on this balloon to figure out exactly what kind of technology they had, what kind of scanners and cameras and what kind of data they actually had and were collecting, as well as what kind of data not only they were collecting, but were able to beam back to China before this spy balloon was shot down. Presumably, all of the data that was on it was able already to be sent back to China. But look, China does this sort of stuff, right? Like 15 years ago, they stole designs for our F-35 fighter jet. That's the Lockheed Martin F-35 Gen 5 plane. I mean, this is really important. And so what they end up doing, they ended up making a pretty similar plane. Now, most of their jets are still like Gen 4 or even older, like the 90s Gen 3 kind of stuff. But I mean, they've done this before. Chinese hackers have stolen security clearance files from 22 million Americans in 2025. They've stolen medical files from Anthem. They've stolen travel records from Marriott. The difference with this balloon, because they always steal our stuff or try to steal our stuff, is it was sort of like theft right in our face. And that's pretty ugly, right? So there's certainly the geopolitical risk here. There you've got Ukraine and Russia risks. You've got Iran and Russia risks. This idea that now Iran is partnering with Russia to manufacture potentially 6,000 kamikaze drones by building a factory in Russia, so that way they can be sent straight from Russia to the front lines. You've got the treasury yields market that's clearly at least showing some short-term nervousness. We had recently fallen to a low of about 3.35 on the 10-year. Right now we're sitting over 3.6 again, which just drives the real estate market down further. So you do have a lot of reasons to be nervous. BTC back under 23,000, which is sort of like I always like to consider it your risk gauge. And we got rejected at 24, and now all of a sudden the stock market's a little bit more tentative. On top of that, you've got the earthquakes that are going on in Turkey, which aren't necessarily a lagging risk right now to the stock market, but they are something that guess what? Now Turkey is having to shut down certain oil facilities in the Turkish region because of a 7.8 magnitude earthquake that hit, followed by a 7.5 aftershock, potentially 1,300 dead in Syria and Turkey, and now you got oil futures rising on that thought, and you're back to almost $81 for Brent, which is probably your biggest inflationary impulse. So you have a lot of uncertainties. And at the same time as you have a lot of uncertainties, you have mixed data coming in as well, right? The JOLTS data came in high, which Jerome Powell sort of brushed off. The employment cost index came in at 1%, but still, that's 4.4% annualized. For wage gains, that's still too high, right? It's nowhere near 2%. Factory orders in Germany coming in stronger than expected, retail sales in America coming in weaker than expected. All across the world, it's sort of like, man, got some good, some bad. A lot of companies talking about inflation risks going down, but what do you have? You have companies like Hershey telling you that they still are experiencing inflationary pressures still today. And what I thought was the most interesting out of the Hershey earnings call, because remember, this is what I do. I read earnings calls. I love reading and sharing the information with you. Is you find nuggets like this. Hershey says historically, after they raise prices, you actually don't end up reducing prices. That's just not how market dynamics in the candy market work. So in other words, once you get the inflation, you're stuck with it. Now the good news is, as long as prices stay stable and they don't actually expect to raise prices, which they don't, but you could actually bring inflation technically back to zero. It's just now everything's been reset to a higher level. But still, all of these things create substantial uncertainties. And so, yeah, this is where people say, look, the first recession needs to be aligned with, if we have a recession, needs to be aligned with, well, inflation going away. Because if inflation doesn't convincingly go away and the Fed has to hawk through a recession, then that's where the real pain could come. And as Burry and this bond dude suggest, you could end up being in a double dip recession. Now, this chart is really fascinating, is one to pay attention to. This is the probability that the next recession in the economic cycle has started. We briefly looked at this just the other day, but it's important to look at because it's very historically accurate. Doesn't mean it will be going forward, but probably one of the most important indicators of a recession, or reliable indicators of a recession actually happening, are the inverted yield curves. And this one in particular is the Fed's favorite. It's called the 3-month, 10-year inversion. And so you could see that on the bottom, which is basically this upside down little blue mountain over here. And basically, the depth of this inversion is the deepest that we've seen since the 80s. It's pretty dang deep. And in the 80s, we had a pretty darn ugly recession because we ended up having to get Paul Volcker. Now, eventually, the depth of the inversion is correlated with the amount that in the future the bond market actually expects the Federal Reserve will cut interest rates. So yes, at some point we're going to get massive interest rate cuts. The question is just, do we end up having a single recession? Do we have no recession? Or do we have a double dip recession? Nobody really knows. In fact, according to this chart, the odds that we're in a recession right now are less than 2%. In fact, it's more likely that the recession is still somewhere around 6 months out, according to the inverted yield curve. That would put us into a recession somewhere around August. And then we'd be within a sort of one standard deviation range of the recession being somewhere between August and December. Now, if by that point, inflation actually is convincingly low, and how can we get convincingly low inflation? And we'll talk about the if. Well, to get convincingly low inflation, you need goods to continue their trend down, which they already are. That's good. In addition to goods continuing their trend down, what do you need? You need that household inflation to come through. That inflation sort of a metric from owners' equivalent rents. We have got to see that continued weakness in that housing sector, right? But on top of that, we have to see service wage inflation go down. Service wage inflation is going to be like medical care, haircuts, accounting services, basic services that even car insurance that you spend money on just to sort of live, right? And the hope is that by the time we get to the summer, say June or July, hopefully before we walk into a recession, these numbers are starting to convincingly disinflate. Disinflate is different from deflation, right? Deflation is falling prices. whereas disinflation is prices that are growing at a slower rate, right? So that's falling versus slower rate of growth. Anyway, as long as we can get this and we can confirm, okay, we have a slower rate of inflation in wages, then the Federal Reserve can actually preemptively try to soften the blow of us walking into a recession, and maybe we completely avoid a recession entirely. However, if we don't get that service side deflation, or disinflation, I should say, then yeah, it's entirely possible that we walk into a recession. Not only do we walk into a recession, but then the Fed cuts, but inflation still stays sticky, and then we end up getting the worse double dip recession on the heels of that thereafter. Now, again, unfortunately, it looks like wage inflation is actually stabilizing. This is important. You look at a company like Starbucks, and what are they telling you? Wow, it's a lot easier to hire people, a lot less labor turnover. What does less labor turnover mean? It means less wage inflation. Very, very important. Less wage inflation is exactly what we're looking for here. Now, the fascinating part is that a year ago, companies were telling you exactly the opposite. They were telling you, oh no, we are having a hard time keeping our employees, and we're having to pay more to get more employees right now. The only place you're really seeing that now is in certain sectors of the airline industry, like pilots. It's still very difficult to hire pilots because there's so few of them. You still have a smaller industry now than you did before the pandemic, and that's a problem because you had so many retirements. But you are still seeing hope and good news that that wage inflation is going to go down. Same thing Starbucks is saying is what Chipotle is saying, and a lot of companies suggesting, hey, look, finally we're seeing those wage pressures go away. That's great, but right now it's just hope that it continues to move in that direction. Now, on some good news, we had earnings this morning from Tyson Foods. Tyson Foods a year ago was bragging about how much their margins were exploding. They're bragging about how big their PP is. They're bragging about, look at my PP, look at my pricing power. It's so large, it's so huge. That's what they were bragging about last year. And now, what are they bragging about? It's a small PP, basically, which is they're probably not trying to brag about it. But basically, chicken prices were so high, it was easy for them to have high margins. But unfortunately, chicken is a commodity. And when you have a commodity, the price of a commodity generally trends down over time, especially chicken, because you get more producers in. And when you get more producers in, what happens? Oh, wow, chicken prices plummet. Now what's happening? Well, the company did grow revenues relative to last year. They grew less than expected, 13.26 billion versus 13.5 expected, above the 12.933 from last year, but their earnings per share missed bigly. They were expecting $1.31 of EPS, markets were. We got 85 cents. And that's because as chicken prices plummeted, the company's costs were still rising. And so all of a sudden you're getting squeezed on both sides. This is an example of where it's easy for every company to have told us they had big PP last year. But the reality now is, who is actually able to continue to sell product with decent margins while not actually missing estimates as terribly as Tyson Foods did and destroying the margins? So in other words, where can you remain competitive in a recession while still maintaining profitability? Tyson Food, a little bit of an oopsie-doopsie today with substantially less profitability than expected. And this is totally the opposite of what we saw last year. So this is great, but look, you know, we are still waiting for substantially more certainty on what's going to happen. You've got Morgan Stanley's Mike Wilson going, see, told you, bear market rally, everything's going to go down again. Obviously, futures right now are red, just about 1/2 to 1/3 or 2/3%, depending on which index. You've got Goldman Sachs saying, hey, the January rally is as good as it gets. You've got Dell announcing that they're cutting 5% of jobs, citing the lack of PC demand. You've got Deutsche Bank now looking at strategic job cuts. You've got portfolio managers talking about this regime shift of potentially higher rates staying for longer. We saw this double dip guy. And the double dip guy, you know, on one hand, he's kind of like, hey, look, in this, I'm giving him credence here, or you know, credit essentially here. He's talking about how right now people can kind of spend through this recession, right? They can hold out because they could just take on debt, or they have the savings. They can spend through the downside. Well, I hate to say it, but when I looked at the earnings call for American Express, they used the phrase that consumers right now, especially American Express users, are spending through this recession. And that's basically reiterating what this double dip individual is suggesting, that, hey, look, right now, people aren't actually yet treating this like a recession because they're just taking on more debt or loading up credit cards to spend through it. Sort of like the idea that, hey, you know what? We just have to get through the next 6 months and then we're good, and then we'll pay off the debts that we accrue. That's great, and it relies on the hope that this is over after, we can prove disinflation. But if we don't, then yeah, double dip becomes possible. So you want to hedge for that possibility, and the best way to generally hedge for that sort of possibility is making sure you're not exposed substantially to debts that could get margin called, short amortization periods, and you're not exposed to potential job loss. Now, if we actually look at reports from Goldman Sachs and Morgan Stanley, we can get a little bit of insight into sort of their thoughts. We get, first of all, insight into the European Central Bank hoping that inflation is mostly now conquered, or at least on the path to being conquered. And they're actually starting to taper how much they are basically quantitatively tightening. So they're reducing their tightening efforts already. And they're pointing out to a more balanced inflation outlook. That's great. This is sort of the European outlook from Morgan Stanley, but Morgan Stanley and a lot of investment banks right now are saying that emerging markets and Europe are actually faring a lot better than the United States, that the United States is more at risk of an earnings recession than other countries or emerging markets. If we look at a piece from Goldman Sachs over here, we talk about this idea here that in quick disinflation right now is what's being priced into markets. And that actually creates a risk in itself, that now all of a sudden everybody is too optimistic that we are pricing in so much disinflation that if that doesn't happen in the face of mixed data, and then we start getting realistic data, like maybe potentially you have of car prices starting to rise again, then what you end up having is forces that were disinflationary in the last few months starting to become inflationary again. And if it takes longer for the housing market to bring home prices or rents down, yikes, then that quick disinflation and the rate cuts markets are pricing in is all for nothing. Now, one of the interesting notes here from Goldman Sachs is that, hey, look, housing starts coming out over the middle of this year will probably help drive inventory up substantially as home builders actually try to finalize some of their building. They get through the construction backlogs, and you could actually see some downward pressure on real estate in the second half of the year. And yeah, the market is pricing in that sort of disinflation, but be careful, because even though we have signs that, hey, these numbers should come down, if for whatever reason they don't, you got a big oopsie doopsie coming your way. So be careful. And they suggest here that it's probably going to be until the end of the year, according to this particular individual at Goldman Sachs, before the Fed is actually confident that the inflation fight has been won. And so Goldman doesn't actually think you're going to see a 50 basis point rate cut until December, even though we've been hearing about rate cuts coming as soon as September based on what the bond market's expectations are. Goldman here suggesting that we'll probably end up sitting around 3 to 3.5% as sort of a neutral rate once we get into the cutting cycle, be it next year. We'll see. But a lot of uncertainty. And is it possible there could be a double dip? Yeah, numbers are still very mixed. And so I think it's important to sort of stay the course on, okay, be conservative, have long exposure, but don't go YOLO. Not just yet. Anyway, this gives us some insight here into some of the madness and uncertainty that we're going to be dealing with. I think it's actually great that we are starting to see more of a balanced labor force for businesses. Even as the unemployment rate is as low as it is, it seems like, at least from the front lines, companies are suggesting, look, no real concerns of a wage price spiral, which reiterates what Jerome Powell had suggested in his FOMC press conference. So I think there are reasons to be optimistic, but there are definitely risks and nervous catalysts that should make us nervous that we want to pay attention to. This week we do get some more earnings as well. Powell talks tomorrow. Biden's got a State of the Union tomorrow as well. That's Tuesday. You've got sentiment data coming out Friday. You've got Waller and Hawker talking Friday. You've also got earnings from companies like KKR, the real estate business, BNP, BP, Nintendo, Pepsi, Semiconductor Manufacturing International, Siemens, SoftBank, Toyota, Uber, Disney, Tyson we just got and talked about, Energizer, Royal Caribbean, Hertz, Fiserv, CVS, Hilton, and Credit Suisse all coming out this week. So we'll get some more data, but we know what to look for. And boy, oh boy, there's a lot to look for.